Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 24th of October. It's been quite a week. For the wrong reasons, the UK has taken centre stage in terms of the global investment community. Clearly, apart from the political machinations of the resignation of the Prime Minister, there's also been an attempt at unwinding the mini-budget fiscal event, which obviously dented the hopes not only of the UK as that investment destination, but also more markedly in sterling. Sterling's currently somewhere around 111, 112 to the dollar, so clearly better than the 103 it dipped to after the mini budget. Having said that, of course, the US dollar has been on a tear this year, and the opening level was actually 135 at the beginning of 2022. In terms of the economic outlook for the UK, we've had some increase in government borrowing, decrease in retail sales. It's probably the FTSE 250, the more domestically focused index, which has taken the brunt of investor ire. The FTSE 250 is down nearly 27% in the year to date. Elsewhere, of course, the song remains the same. In the US, there have been further concerns, not only around inflation, but just how aggressive the Federal Reserve is going to continue to be in an effort to tame inflation, even though potentially that could lead the world's largest economy into recessionary territory. So in the year to date, we're in the situation where the Dow Jones is down by 16.5%, the S&P by 23%, NASDAQ by 32%, and the FTSE 100 is currently trailing by 6.6%. Turning to next week in the UK reporting arena, it's quite a busy week again, particularly for the UK banks. Now, we're going to probably have a couple of read across from the US Q3 reporting season we've just heard in terms of the banks. For example, there's been something of a dent in mortgage demand, but also banks making more provisions in terms of bad debt. So it's very possible that could come the UK's way as well. On top of that, of course, you're going to have the normal metrics to see just how the banks are doing in terms of net interest income, net interest margin, the capital cushion, their current views on raising dividends or increasing buybacks, investment banking where applicable, and return on tangible equity, another key metric for the banks. In terms of the banks themselves, they've had a fairly mixed performance. Over the last year, Lloyds, for example, down 12.5%. Barclays are down 26%, NatWest down 4%, HSBC and Standard Chartered rather better, up 9% and 17% respectively, on hopes of something of a recovery in Asia. Nor does the reporting stop there. We're also looking out for Q3 numbers, which will give us various indications of consumer behaviour and where we may be going at the moment. Q3 numbers from the likes of Whitbread and Unilever, and also Shell. Obviously, on the back of a strong oil price, shares are up some 43% in the year to date. So we'll see there also what their current intentions are in terms of shareholder returns. Thank you for watching. Have a great week.